Welcome to This Explainer. Today, we're putting on our professional sell-side equity analyst hats. We're going to conduct a rigorous, strictly numbers-driven reality check on Corning Incorporated, ticker symbol GLW. We'll be looking entirely at the fundamental data from our source documents to see if the market's current narrative actually matches up with the cold, hard financial reality. Here's our agenda for today. First, the stock price phenomenon. Second, unpacking growth and returns. Third, assessing financial health. Fourth, relative valuation multiples. Fifth, intrinsic value and DCF. And finally, our final analyst verdict. Let's dive right in. Section 1. The stock price phenomenon. Just look at this number, 113.90%. That is Corning's year-to-date return based on our data. Honestly, if you looked at this metric alone, you'd be totally forgiven for thinking Corning was the single greatest stock on Earth right now. A return like that naturally attracts a huge amount of bullish sentiment, momentum traders, and of course, retail excitement.
But this right here, this brilliantly illustrates the friction between market expectation and operational reality. The trailing 12 months total return for the stock is an absolute rocket ship at 321.22%. However, when we actually look at the underlying business, the revenue compound annual growth rate over that exact same trailing 12-month period is only 19.14%. So the stock price is accelerating at a massive multiple compared to the actual top-line revenue coming in the door.
Let's move to Section 2, unpacking growth and returns. Taking a slightly longer-term perspective gives us a very different picture. If you look at the 3-year averages right there in the middle column, the net income compound annual growth rate is only 6.64%, and the free cash flow CAGR, that sits at 11.79%. So while the trailing 12-month figures show a recent spike, these 3- and 5-year averages reveal a company with steady, but definitely not explosive operational growth. It's a solid business, for sure, but as analysts, we really have to ask ourselves if a roughly 11% free cash flow growth rate justifies a 300+% surge in the stock price. So the crucial point here is the return on invested capital, or ROIC, which stands at just 7.30%. As fundamental analysts, we rely heavily on ROIC to tell us how effectively management is using its capital to generate actual cash returns. At 7.30, well, it's positive, and it's actually an improvement over its 3-year average of 3.92%, but still, it is a very grounded single-digit return profile.
Section 3. Assessing financial health.
Looking at the liquidity and leverage metrics here, the picture is quite solid. We've got a debt-to-equity ratio of 0.71, meaning they aren't overly leveraged. The debt load is completely manageable. The current ratio is 1.59, and the quick ratio is 1.04. This tells us that Corning has more than enough liquid assets to cover its short-term obligations. So, from a pure solvency standpoint, the base financials are very stable.
However, as rigorous analysts, we've got to acknowledge the boundaries of our data. Because our source documents lack the granular, segment-by-segment cash flow data needed, we simply cannot reliably construct a sum of the parts, or SOTP, valuation. We also lack the detailed line-item breakdowns required to run an expanded liquidation value model. We have to explicitly state those analytical limitations up front. So we're going to focus our efforts on the comprehensive valuation models we can run with high confidence using the data provided.
All right, Section 4. Relative valuation multiples. The stark contrast here is absolutely critical. Just look at these premiums. The current price-to-earnings ratio sits at an eye-watering 101.60 that drastically outpaces its 3-year average of 75.19. The enterprise value to EBITDA ratio is 45.90 compared to a historical 25.28, and the price-to-sales ratio is 10.26, up well over 140% from its 3-year average. Across the board, these multiples indicate historically stretched pricing. Investors are literally paying a massive premium for every single dollar of sales and earnings compared to what they paid just a few years ago. Furthermore, if we flip those multiples upside down to look at the yields, the story gets even tougher for value investors. The earnings yield is exactly 1%, and the free cash flow yield is just 0.88%. That means for a stock with a current sky-high market cap of over $160 billion, the fundamental cash return you are getting as an owner is less than 1%. In a market where risk-free rates often yield substantially more, this is a glaring metric that demands our attention.
Which brings us to Section 5, Intrinsic Value and DCF.
Just as a quick refresher, a discounted cash flow, or DCF, is a valuation method used to estimate the value of an investment based on its expected future cash flows. It simply projects out the future unlevered free cash flows of the business and discounts them back to their present value. This strips away all the market sentiment, the retail hype, and the momentum, and it gives us a fair mathematical baseline for what the stock is actually worth today.
And this is where our forensic analysis hits a brick wall of reality. Against a current trading price of $186.94 per share, the discounted cash flow fair value output from our data sits at just $25.10. I mean, let that sink in for a second. Even if we look at the fair value based on earnings per share, it only bumps up slightly to $28.33. The chasm between the current trading price on the open market and the intrinsic fair value is simply immense.
Because of that incredible fundamental disconnect, our calculated margin of safety sits at an extreme negative 644.92%. Now, in value investing, you want a positive margin of safety. You want to buy a stock for less than its intrinsic value to protect your downside. Buying a stock with a negative 644% margin of safety, that means you are paying an extraordinary premium based entirely on future growth expectations that are not yet remotely materialized in the actual cash flows. Now, you might be wondering about dividends as an alternate way to value the firm. While Corning does have a dividend yield of 0.60%, we have to be disciplined analysts here. The lack of distinct, long-term, sustainable rate projections in our current data set means we actually have to exclude the dividend discount model, or DDM, for now. Doing a multi-stage DDM requires assumptions about future payout ratios that our current filings just don't reliably support. Therefore, we must rely entirely on our absolute DCF and EPS fair value modeling, which, as we literally just saw, are signaling massive overvaluation. Finally, Section 6, the final analyst verdict. Let's review the tape. The bull case is built almost entirely on incredible price momentum. A 321% total return over the last 12 months is super hard to ignore, and the balance sheet is relatively stable. But the bear case is anchored in the raw fundamentals, where the DCF fair value is just $25.10. The reality is that valuation multiples are historically stretched to their absolute limits. So our sell-side reality check concludes that while market momentum is undeniably bullish right now, the intrinsic valuation is critically overextended. It is completely detached from the underlying operational cash flows of the business.
Which leaves us with one final, undeniable question to ponder as we wrap up this explainer. With a margin of safety at negative 644%, are investors pricing in an absolute operational miracle for Corning, or are they just ignoring the math entirely? It's a fascinating case study in market psychology versus fundamental reality. Thanks so much for joining me on this deep dive. I hope that structured look at the numbers helps you clearly understand the landscape.